If you're retired or planning to retire soon, the 2026 tax year is going to be a complete game changer. And I'm not exaggerating.
The IRS just released the new tax brackets for 2026. And combined with the recently passed One Big Beautiful Bill Act, or OBBBA, as it's being called, there are massive changes coming that could either save you thousands of dollars or cost you dearly if you're not prepared. So what exactly is happening? Why are financial experts calling 2026 a watershed moment for American retirees? And more importantly, what do you need to do right now to protect your retirement income? Let's break it all down. For nearly a decade, retirees have been living under a cloud of uncertainty. Remember the Tax Cuts and Jobs Act from 2017? Those lower tax rates and bigger standard deductions were supposed to expire at the end of 2025. Everyone was bracing for a massive tax increase in 2026. But here's what happened. Congress just passed the One Big Beautiful Bill Act, and it made those lower tax rates permanent. So the tax brackets we've been enjoying, the 10%, 12%, 22%, 24%, 32%, 35%, and 37% rates, they're here to stay. Now, you might think, great news, right? Case closed. Not so fast, because while Congress locked in those lower rates, they also added a whole bunch of new deductions, phase-outs, and income thresholds that create what tax professionals are calling toxic zones. Specific income ranges where earning just one more dollar could cost you way more than you'd expect. Let me show you what I mean. For 2026, the tax brackets have been adjusted for inflation. But here's something interesting. The IRS didn't use the same inflation rate for all the brackets. For the two lowest brackets, the 10% and 12% brackets, they applied a higher inflation adjustment of about 4%. This was specifically designed to give more relief to lower-income households. But for the upper brackets, they only applied a 2.3% to 2.7% adjustment. Here's what this means in real numbers. If you're married filing jointly in 2026, you pay 10% on income up to $24,800. Then 12% on income from $24,801 up to $100,800. Then 22% on income from $100,801 up to $211,400. And 24% on income from $211,401 all the way up to $403,550. That 24% bracket is absolutely huge. Think about this. A married couple can have over $400,000 of taxable income and still stay under a 25% tax rate. For Roth conversion strategies and capital gains planning, this is golden. But here's the catch, and this is really important. Social Security benefits are going up by about 2.8% in 2026 due to the cost of living adjustment. But the tax brackets are only going up by 2.3% to 2.7%. What does this mean? It means bracket creep. Over the next 10 to 15 years of your retirement, more and more of your income is going to get pushed into higher tax brackets, even if your purchasing power stays exactly the same. It's a silent wealth eraser that most people don't even notice happening. Now let's talk about the standard deduction for 2026, because this is your foundation. For married couples filing jointly, the standard deduction is projected to be $32,200. For single filers, it's $16,100. But here's where it gets better if you're 65 or older. You get an additional standard deduction on top of that base amount. For single filers age 65 and up, you add $2,050. For married couples where both spouses are 65 or older, you add $1,650 for each spouse. Do the math with me here. A married couple, both age 65 or older, gets a standard deduction of $32,200 plus $1,650 plus another $1,650. That's $35,500 of income that's completely tax-free before they pay a single penny in federal income tax. For a single senior, it's $18,150 tax-free. This high zero tax floor is absolutely the foundation of smart retirement tax planning. But Congress didn't stop there. They added something brand new on top of it. This is where things get really interesting and complicated. Starting in 2025 and running through 2028, there's a brand new deduction called the senior deduction. If you're 65 or older, you get an additional $6,000 deduction. If you're married and both of you are 65 or older, you get $12,000. And this isn't an itemized deduction. You get this on top of your standard deduction. It's essentially free money that reduces your taxable income. Politicians marketed this as a way to eliminate taxes on Social Security benefits. And for some people, it does exactly that. If you're a married couple with $30,000 in Social Security benefits, where 85% of that, or $25,500, is normally taxable, this $12,000 deduction wipes out nearly half of that tax. But here's the massive catch. This deduction doesn't last forever, and it doesn't apply to everyone. The senior deduction starts phasing out based on your modified adjusted gross income, or MAGI. For single filers, the phase-out starts at $75,000, and you lose the entire deduction once you hit $175,000. For married couples, it starts phasing out at $150,000 and disappears completely at $250,000. And this is where the math gets brutal. The deduction phases out at a rate of 6% for every dollar of income above those thresholds. What does this mean in practice? Let's say you're a married couple with $200,000 in income. You're right in the middle of the phase-out zone. If you realize an extra $10,000 of income, maybe from a Roth conversion or selling some stock, here's what happens. You pay your normal 24% tax on that $10,000, which is $2,400. But you also lose $1,200 of your senior deduction because of the 6% phase-out. That lost deduction costs you another $288 in taxes. So your total tax on that $10,000 is actually $2,688. Your effective tax rate isn't 24%. It's 26.9%. Tax experts are calling this a phantom tax, an invisible surcharge that most retirees won't even realize they're paying. And if you're in that income range between $150,000 and $250,000, every financial decision you make needs to account for this hidden cost. Now let's talk about one of the most dramatic changes in the 2026 tax landscape: the state and local tax deduction, or SALT. Since 2018, there's been a $10,000 cap on how much you could deduct for state and local taxes. If you lived in a high-tax state like New York, California, or New Jersey, this cap absolutely killed you. You might have been paying $30,000, $40,000, even $50,000 in state income taxes and property taxes, but you could only deduct $10,000 of it. Well, here's the big news. For tax years 2025 through 2029, the OBBB raises that cap from $10,000 to $40,000. And it's indexed for inflation. So in 2026, the cap is projected to be about $40,400. This is a quadrupling of the deduction limit. And what it means is that many retirees who've been taking the standard deduction for the past several years are suddenly going to find it beneficial to itemize again. Let me give you an example. You're a retired couple in New York. You pay $18,000 a year in property taxes and $20,000 in state income taxes. That's $38,000 in SALT. Under the old law, you could only deduct $10,000 of that, so you took the $32,200 standard deduction instead. But in 2026, you can deduct that entire $38,000, and if you add in some mortgage interest or charitable donations, you're now way above the standard deduction. Itemizing saves you thousands. But, and there's always a but with tax law, Congress also added a nasty phase-out for high earners. If your MAGI exceeds $500,000, your SALT deduction starts getting clawed back. For every dollar over $500,000, your SALT cap is reduced by 30 cents. So if you have $550,000 in income, that's $50,000 over the threshold. 30% of $50,000 is $15,000. Your SALT cap drops from $40,400 down to $25,400. And here's why this is so punishing. Let's say you realize a $50,000 capital gain that pushes your income from $500,000 to $550,000. You're going to pay capital gains tax of 20% plus the 3.8% net investment income tax on that gain. That's $11,900. But you also just lost $15,000 worth of SALT deductions. And if you're in the 35% bracket, that costs you another $5,250 in taxes. So your total tax bill on that $50,000 gain? Over $17,000. Your effective tax rate on what should be a preferential capital gain is actually 34%. This is what financial planners mean when they talk about toxic zones. The interaction of multiple phase-outs creates these income ranges where you absolutely do not want to be. If you're someone who likes to give to charity, the OBBBA also made some significant changes here. First, there's a new floor for charitable deductions. If you itemize, you can only deduct charitable contributions that exceed 0.5% of your adjusted gross income. So if you have $200,000 in AGI, the first $1,000 you donate is essentially non-deductible. Only donations above that $1,000 threshold count. Second, for taxpayers in the top 37% bracket, the value of itemized deductions is now capped at 35%. This means even though you're in the 37% bracket, you only save 35 cents on the dollar for your deductions. Congress basically created a permanent 2% penalty for high earners. But here's the good news. For people who take the standard deduction, there's now a permanent above-the-line charitable deduction of $1,000 for single filers and $2,000 for married couples. So if you're not itemizing, but you still want to support your favorite charities, you can deduct up to $2,000 without having to mess with itemizing at all. This is separate from qualified charitable distributions, or QCDS, which remain one of the absolute best tax strategies for retirees over 70 and a half. Let's shift gears and talk about investment income, because this is where some of the biggest opportunities exist. The preferential tax rates for long-term capital gains and qualified dividends remain permanent under the OBBBA. In 2026, if you're married filing jointly, you pay 0% on capital gains up to $98,900 of taxable income, 15% on gains from $98,901 up to $613,700, 20% on gains over $613,700. That 0% bracket is huge. Think about this strategy. Let's say you're a married couple with $60,000 in pension income. After your standard deduction of $35,500, you have $24,500 of taxable income. You could realize up to $74,400 more in long-term capital gains, filling up that bucket to $98,900, and pay absolutely zero federal tax on those gains. This is the most powerful tool for stepping up your cost basis during retirement. You sell appreciated assets, pay no tax, and immediately buy them back at the new, higher basis. It's called gains harvesting, and 2026 offers an incredible window to do this. But here's where you need to be careful. There's a trap waiting at $250,000 of income. Once your income crosses $200,000 as a single filer or $250,000 as a married couple, you trigger the net investment income tax, or NIIT. This is a 3.8% surtax on all your investment income, capital gains, dividends, interest, rental income. And here's the really insidious part. These thresholds are not indexed for inflation. They've been stuck at $200,000 and $250,000 since this tax was created back in 2013. What does this mean? A couple earning $250,000 in 2026 has significantly less purchasing power than a couple earning $250,000 in 2013. But they face the exact same tax threshold. As your income rises due to cost of living adjustments and inflation over the next 10, 15, 20 years of retirement, more and more of you are going to drift into NIIT liability, without your real income actually increasing at all. And when you combine NIIT with the senior deduction phase-out we talked about earlier, that income range between $200,000 and $250,000 becomes what planners are calling a toxic zone. You're paying 24% in regular income tax, plus 3.8% NIIT, plus the 6% phantom tax from the senior deduction phase-out. You're looking at effective marginal rates well over 30%, possibly pushing 40% when you factor in state taxes. The strategic takeaway? If your income naturally falls in this range, you need to be extremely careful about when and how you realize additional income. Roth conversions, large capital gains, even taking extra retirement account distributions. All of these decisions need to be analyzed with these phase-outs in mind. And speaking of income thresholds, we need to talk about something that catches retirees completely off guard every single year. Medicare IRMAA. IRMA stands for Income-Related Monthly Adjustment Amount. It's basically a surcharge on your Medicare Part B and Part D premiums based on your income from 2 years prior. So in 2026, Medicare is going to look at your 20 to 24 tax return to determine your premiums. The standard Part B premium for 20 to 26 is projected to be about $203 per month. But if you're a married couple and your 224 income exceeded $218,000, you're going to pay more. A lot more. Here's how the brackets break down. At $218,000 to $274,000, your premium jumps to about $284 per month, an extra $81 per person. At $274,000 to $342,000, you're paying about $406 per month. At $342,000 to $410,000, it's $528 per month. At $410,000 to $750,000, it's $649 per month. And over $750,000, you're paying $690 per month. For a married couple, you're paying these surcharges for both of you. So if you cross that first threshold at $218,000, you're suddenly paying an extra $1,944 per year in Medicare premiums. Cross the next threshold, and it's nearly $5,000 extra per year. And here's what makes this especially painful. This ties directly into that toxic zone we keep talking about. A married couple earning between $218,000 and $274,000 is getting hit with IRMA surcharges. They're in the NIIT zone, and they're losing their senior deduction. The marginal cost of earning an extra dollar in this range can be brutal, sometimes exceeding 50% when you add up all the taxes and surcharges. The key lesson here is that income planning for retirees isn't just about tax brackets anymore. It's about managing your income to avoid these invisible cliffs that can cost you thousands. Now, let's talk about estate taxes, because this is one area where there's genuinely good news. The OBBBA permanently raises the estate and gift tax exemption to $15 million per individual. For a married couple, that's a combined $30 million exemption. What this means is that the federal estate tax, the so-called death tax, is now effectively eliminated for 99.9% of American households. Unless you're in the top 0.1% of wealth, you simply don't need to worry about federal estate taxes anymore. And this actually changes the planning calculus in an important way. For years, wealthy retirees were encouraged to give assets away during their lifetime to reduce their taxable estate. But now, with this massive exemption, the focus has shifted almost entirely to income tax basis management. Here's why. When you die, your assets get a step up in basis. If you bought stock for $10,000 and it's now worth $100,000, your heirs inherit it at the full $100,000 value. They can sell it immediately and pay zero capital gains tax. But if you give that stock away while you're alive, your heirs inherit your original $10,000 basis. When they sell it, they owe capital gains tax on $90,000 of appreciation. So for most retirees now, the better strategy is to hold highly appreciated assets until death, rather than gifting them during your lifetime. The step up in basis is worth far more than any estate tax savings you might have achieved. The OBBBA also created some interesting new deductions that might apply to certain retirees. There's a new above-the-line deduction for auto loan interest on vehicles that are assembled in the United States. You can deduct up to $10,000 per year in interest, but it starts phasing out at $100,000 of income for single filers and $200,000 for married couples. Now, most retirees aren't carrying car loans, but here's an interesting planning strategy. If you're buying a new vehicle, maybe a luxury car, maybe an RV, and you're in one of these income phase-out zones, it might actually make sense to finance the vehicle rather than paying cash. Why? Because if you can deduct the interest, and that deduction lowers your AGI enough to save you from RMDs surcharges, or preserve your senior deduction, the tax savings might be worth more than the interest you're paying. If your loan is at 6% interest, but the deduction saves you 24% in taxes, plus additional surcharges, your effective interest rate might only be 4%. And if your investment portfolio is earning 7%, you're actually coming out ahead by financing. There are also new deductions for tip income and overtime pay, though these are primarily targeted at working Americans. But if you're a retiree working an encore career in the service industry or doing hourly consulting work, you should absolutely be aware of these provisions. So what's the bottom line? What should you actually be doing with all this information? First, understand where you fall in the income spectrum. Are you in the sweet spot, under $150,000, where you get the full senior deduction, and you're not hitting any of these phase-outs? Or are you in one of these toxic zones between $150,000 and $250,000, or above $500,000? Second, if you're in a high-tax state and you have significant SALT expenses, run the numbers to see if itemizing makes sense for you in 2026. With the cap raised to $40,400, many people who've been taking the standard deduction are going to benefit from itemizing. Third, consider a bunching strategy. In year one, prepay property taxes and make large charitable contributions to maximize itemizing. In year two, minimize deductions and take the standard deduction. Over a 2-year cycle, you'll likely get significantly more total deductions than taking the standard deduction every year. Fourth, if you're between $200,000 and $250,000 in income, be extremely strategic about when you realize additional income. This is not the range where you want to do large Roth conversions or realize unnecessary capital gains. The combination of phase-outs makes this one of the most expensive income ranges in the entire tax code. And fifth, don't forget about capital gains harvesting. If you're in the 0% capital gains bracket, use it. Sell appreciated assets, pay no tax, and reset your cost basis higher. This is free money that the tax code is offering you. Here's what I want you to understand. The 2026 tax code is not simple. Congress made the rates permanent, which is good. But they layered on all these phase-outs and thresholds that create hidden traps everywhere. Your effective tax rate, the actual percentage of your income that you're giving to the government, is no longer something you can just look up in a table. It's a bespoke calculation based on your specific mix of income sources and where you fall relative to all these phase-outs. For the prepared retiree, 2026 offers unprecedented opportunities for deduction stacking and strategic income planning. But for the unprepared, it threatens a quiet but very real erosion of wealth through phase-outs and surcharges that most people will never even notice. The key is to be proactive. Work with a qualified tax professional or financial planner who understands these new rules. Model out your income for the next few years. Understand where the cliffs are and plan your income realization accordingly. Because here's the truth. In retirement, it's not about how much income you have. It's about how much income you get to keep after taxes. And in 2026, keeping more of your money is going to require more sophistication and planning than ever before. If you found this video helpful, please hit that like button and subscribe to the channel. We're going to continue covering these tax changes and their implications as more details emerge. And drop a comment below. I want to hear your situation. Are you in one of these phase-out zones? How are you planning to navigate 2026? Thanks for watching, and I'll see you in the next video.